Hey guys, is there a more boring topic than talking about bonds? Now, here's the thing, bonds are super important. Even if you never trade a bond, if you never invest in a bond, if you never go a mile close to a bond, bonds matter because they tell us what's going on with inflation, tells us what's going on with the stock market, it tells us what's going on with stability, future stability. So what I want to do is look at bonds this week and have them really tell us, hey, is the market okay? Or are those internals that are weakening, are they transitory, meaning they're going to just move through, or are they here to stay and getting worse? And what bonds are the best ones to be in? If you want to be in bonds, or if you have to be in bonds, which ones should you be in? And three is always all the other stuff that we're going to get from what bonds are telling us about what's going on in the world and inflation. So let's jump into it. Okay, guys, what I want to do is start off with just BND. This is the Vanguard Total Bond Market ETF. This is kind of the S&P 500 of bonds in the US. I'll also show the all-world bond market, ex-US, so you see that. So a couple things. This is a 3.5-year price chart. I just want you to see a couple things here. That is kind of the go, no-go, generally speaking, for the bond complex in the US. If the black line, which is the closing price of BND, is below that, that just means bonds are really weak. Now, it's fighting that line, and you can see right here, that was really the COVID crash. And you could tell, you don't need to know much about price charts, but look at this huge drop. Visually, you know that's a big drop. Bonds are not supposed to do that. Bonds are not supposed to do that. Oh. Okay, did not realize I was not moving over. All right, guys, so let me go over to the price charts and let's look at what the price charts are telling us. Okay, here we go. This is BND. This is the Vanguard Total Bond Market ETF. First thing I just want you to know and notice is this right here. So if the black line, which is the closing price of BND, is below that, that's kind of a bonds are not in good shape. But it's really fighting with that go, no-go area. The other thing I want you to notice is look at here. That's a 9% drop, and that's a very violent drop for bonds. So we've been taught that bonds are safe. They're the safe place to be. But clearly looking at that, the COVID crash scared the heck out of a lot of people, even bondholders. That's not supposed to happen. What's supposed to happen is bonds are supposed to go straight up, and that's it in times of panic. Now, we can look at where the panic started, and I'll do this. So the panic started with the left blue line, and they ended with the right blue line. And so you could see that bonds started going up in the panic of the COVID drop, but then they quickly reversed kind of right in the middle of it. And that's when everyone just started panicking, and they just started going to cash. So as far as today in 2021, here's 2021 starting here. Bonds are down for the year. That means inflation is up. So from an inflationary point of view, inflation is holding on. Now, if bonds stay below that horizontal blue zone, that means inflation's really going to kind of take a hold or stick around longer. And I'm not suggesting you buy BND. Here's BNDX right here. This is the same version, but just it's the International Total Bond ETF, still by Vanguard. You can see here that COVID high right there looks very different. Now it's still below it, right? But that peak right there looks very different, which is actually above that peak. So it depends how you measure this. If you measure this, that COVID peak, that March 6th there, then you have international really weakening even more than US domestic. And going into this, actually international is performing much better. But here's the question. If you have to own bonds, which bonds to own? So there's a lot of different ones you can buy. You can just buy the Total Bond Market Index Fund. LQD are corporate bonds here. And this is clearly the COVID crash. Here's what's so amazing about this. The Fed came out and said they could buy or they may buy corporate. They never bought any corporate bonds. The fact that all the Fed did was use its microphone or its soapbox and say, hey, we can buy corporate. And they absolutely reversed. And now corporate just now is just getting back above the COVID top, but it's just a real mess. I mean, this is a real mess. I'd probably stay away from corporate. Those are corporate bonds. And then you have US Treasuries that just look horrible. Out of all of them you've seen so far, here's the COVID peak right here. That's a triple top. That's a triple top. So what we do know is this. When TLT, which are the iShares 20-year Treasury bond ETF, when they hit about 160, let me get that, 168, sellers just flood the market with their shares. It's happened 3 times. So actually US Treasuries are looking the worst out of all the bonds I've shown you. Now, a really good looking bond are actually municipals. Now, notice how different these look, right? Now, and this is telling us something about the psychology of where people are putting their money. They're not putting their money in treasuries. They're putting their money in municipal bonds. You can see that right here because they look much better from where the COVID peak was. They're above that. The other place money is clearly flowing, just check this out, is treasuries. Sorry, inflation-protected treasuries. These look even better. These look even better. Out of all the bonds I've shown you, inflation-protected treasuries are the place where people are putting their money. Now, this means I'm going to show a yield chart. So this is the yield. I've been showing you price charts up to this point. Now I'm showing you a yield chart. This is the yield of the 10-year Treasury, and it's right back to this 1.4 sitting above it. So it'll be interesting to see if it stays above. Really, 1.4 is down here, so 1.5 is right there. Okay, now I told you whether you are 80 or 60 or 30 or 20 or anything, you want to know. So you want to know about what's going on with bonds. So here's the S&P 500 right there. It's trending higher. This is 3.5-year price chart. Looks beautiful. If I just price this in bonds, it looks no different. Like if you looked away for a second and you didn't know the first price chart, let me go back. This one is priced in US dollars right here. So that's the S&P 500. It costs you about 419 US dollars to buy the S&P. But if you want to use your BND units, it's going to cost you 4.9 BND units. Now BND is an ETF. The point is the S&P is looking great against both of them. Back here, the S&P was falling in price relative to bonds. Here, it was falling relative to bonds, but it bottomed. Back in 08, remember 08? So the peak actually happened in 2007, and bonds were outperforming going into the end of 2007. So there was really good telegraphing going on that the market was getting weaker, and the stock market should never be weaker than the bond market because bond prices move slower. So that's the tell, right? That's why you want to understand how to read the bond market relative to the stock market, because it actually tells you partially if this is just going to be a correction, if people are panicking into bonds or not. But as it is right now, what bonds are telling us is the type of bond you own matters. And inflation-protected bonds are one of the best places to have your bond money. Also, municipal bonds are one of the best places to have your money. Treasuries, not so much. And there's a lot of treasuries, and they all look pretty bad. Corporate, not so much either. And if you want to go international or domestic now is looking better than international. Wasn't that case at the beginning of the year. So bonds tell us a lot because people panic into bonds when things get scary. By the way, in 1987, no one panicked into bonds. The 87 crash, if some of you remember that, the majority of it happened in one day. The market fell 23% in a day. The total drop of the market was 33%. So 23 of 33%, let's call it 70% of the drop happened in one day, which is pretty amazing. No one was panicking into bonds going up to that. That was literally like an equity correction, and that's it. And actually in 1987, the market ended higher for the year in the US. The US was up about 5% for the year. So, okay, so back to bonds. So bonds are basically saying if you want to be in a bond, be in a treasury inflation protected or inflation protected treasury, or be in a municipal bond. So that's really important to know. The other thing bonds are saying is no, the market's not panicking. The market's not weakening. Here's the S&P right here. It's looking good. It's going higher, had a slight correction. Now, there's many different ways to measure the market: large cap, mid cap, small cap, micro cap. So it's not all the same, right? You can measure them differently. But using the S&P as a standard, guys, market's stable. It's going sideways right now. If you look at over right here, just a little bit of sideways. What we do know is growth is underperforming value, and that looks like it's going to continue happening. So the takeaway from bonds are important regardless of your age. Bonds are not saying anything big is coming. If you want to be in a bond, be in an inflation protected or municipal bond. It's hard for me to say muni. Sometimes I say muni in my brain, and then by the time my mouth opens, I start thinking municipal. And then they both come out at the same time. I had this realization. I'm going to wrap this up, but I had this realization. So I've been on YouTube for a long time, before it was a thing to do. And I would just post videos. I wouldn't work on putting a cool thumbnail together or putting a description together. And I was posting for years and nothing. No one would find me. It was never the forefront to build a following on YouTube. But after like a decade, I still didn't have anyone. And so I was like, okay, I'm clearly not doing some simple things, because there are people who've been on, a year and not 20 years that have 500,000, followers and viewers. And so I just made the decision, like, what does YouTube want? They want, good looking thumbnails. They want good descriptions. To have someone stick around in a video, you got to say something kind of spicy in the first 15 seconds. So I started to adjust what I was doing. Now, this has everything to do with investing, and that is, I've noticed people in the stock market or in the investment world market for decades. And even though they've been in for decades, it's not really moving. It's not really going anywhere. And then they take, a training, and they're like, oh my gosh, there's so much I can do. There's so much like simple blocking and tackling. And that's really all that switched with me and YouTube. I don't really make almost anything on YouTube. A rounding error of a rounding error of a rounding error for my annual income. But the point is that some small shifts, I was putting the effort into YouTube videos anyway, so a couple small shifts, I'm now actually starting to see subscriber base grow. And YouTube monetizes videos whether you want them to. They're the ones that put in the commercials in my videos. That's not me, that's YouTube. And when you sign up for YouTube, they basically say, we can do that. But things have really shifted with it as far as people that are following. And I'm still teeny tiny when it comes to YouTube. But the point is, these small shifts that never have happened if I didn't get trained on how to do it would not have started bringing in people who have, would have never met me. So everyone new, thank you for being in my world. If you'd like these videos, please hit the like button, leave a comment, and tell me where I'm right, tell me where I'm wrong, tell me what I'm missing. Like, what am I missing with bonds? Is there something I haven't seen? Is there a bond or a bond category that you love that I haven't looked at, that I didn't talk about? Let me know and I'll take a look at it. Thanks, guys. I appreciate you being in my world. If you like this, you're going to love my free video, Clarity and Control, which is exactly what that absolutely free course, I almost said trading course, but it's not a trading course. That free investing course is going to give you. It's going to give you the clarity and control that you've been looking for. All right, guys, I'm going to hit the pause button. Thank you for being in my world, and I will see you on the next video. Okay, bye.